Hey, Jason here. Today's video, we're going to analyze a commercial real estate property I've been looking at, mobile home park specifically. We're going to look at the numbers in the software that I'm going to show you, and I'll tell you what happened with this investment, why I wanted to go after it, why I went after it, what happened since then, what its metrics were, what its potential returns were, all that stuff. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe to the notification bell so you're notified every time we release a new video, and we release new videos all the time. Okay, I'm going to have a different disclaimer here. If you see my other videos on stocks, I'm going to have a different disclaimer here. This investment I have not invested in. This mobile home community I have not invested in. It's still available, as far as I know, about a week ago. Decided not to go after it. I'll go into details into why. But this is for your informational purposes only, to help you figure out how to use value investing skills like we talk about in most of our stock videos in real estate, commercial real estate specifically today. And also we're going to get into some private businesses I'm looking at as well. For these properties and businesses, I've signed non-disclosure agreements, so I'm going to not reveal the names or the addresses of these properties or these businesses to keep those intact. I'm not going to reveal any proprietary information, reveal anything that was in the financials. I'm just going to stick essentially to the numbers like I do in the stock videos. Again, this is for your informational purposes only, and this is to help you learn how to use value investing skills that we talk about every day in multiple different areas. Okay, why am I doing this? Again, I apologize for that disclaimer. I don't want to do any disclaimer, but every time I don't do a disclaimer, I get nasty comments. Why am I doing this? We put not a poll, I put a question in the Value Investing Journey Facebook group the other day, probably about 2 weeks ago now. And Luke S., who is very active in the group, he said, I asked the question, essentially something along the lines of, I'm personally looking to buy both businesses and commercial real estate. Would you want to see some of those analysis? Would you want to see me analyze, or my analysis of some of those videos, some of those assets? Sorry, I'm struggling right now. To see how you can use value investing skills in other assets other than just stocks. Luke chimed up and said yes. So Luke, this is mainly for you, but it's for anyone out there interested in potentially looking at commercial real estate. Today is what we're going to be talking about. Let me get over here. Okay, so what you're seeing over here is a software that I own, or not that I haven't created this. I own this as part of a program I bought, and it helps me go through real estate investments faster. So we have an asking price up here, 2.4 million. That was a dummy offer price just to kind of play around with the numbers, because you can even down here, you can even figure out like mortgage payments and stuff. So that's a dummy number. That was actually at one point going to be my offer. Before I get to that, we're going to talk about the numbers. Typically for commercial real estate, it's 30% down. Some cases it's higher. This case, I was going to try to put 30% down, which is $660,000. Gross rental income. So think of this as yearly sales for a stock. $313,175 for the yearly number. They have 5% vacancy right now, so this number is subtracted. They could have other income in here. This property did not, except for this, which is things like resident utilities billing system, which is billing clients or tenants back for things like electricity, water, stuff like that. And common area maintenance is CAM, which is things like laundry service, stuff like that. So they do have a small amount of revenue here, and we're going to focus on the actual numbers over here first, and then we'll go to pro forma, because either these are the actual numbers over here, what they've produced in the last year. These are my projections based on what we could do. So we'll start over here. Okay, so we have all the cost here: accounting, administrative, legal, administrative, other, landscaping, maintenance, repair costs. We'll get back to that one in a second, because that number is gigantic, especially compared to the other ones. Trash, utilities, and then it comes down with a percentage down here for total variable expenses. You can add in even taxes and insurance here, property management salary, because I wouldn't want to be managing the property myself. And then this is something I do that a lot of people don't. In the commercial real estate arena is build a capital reserve of some kind. So this is another added expense on a monthly basis that comes out of that is added to the expenses. So this lowers net operating income, which is similar to operating income in stocks that I always talk about, EBIT. This also comes out of cash flow, which is down here. I have this number in here for things like repairs, maintenance, upgrades, upgrading the property. In this case, it was going to go towards buying new mobile home units to upgrade the property, stuff like that. This is essentially a rainy day fund, a maintenance fund, a margin of safety fund, whatever you want to call it. But this adds to the expenses. And again, it adds to my margin of safety as well, because I want this number in here, again, in case any of those things happen. So I'm not kind of screwed. I mean, my investors are kind of not screwed. That gets us to total operating expenses of $133,560 for most commercial real estate. And when I say most commercial real estate, I'm talking specifically mobile home parks, self-storage facilities, and apartment complexes. Those are the ones I target. I look for total operating expense ratios to be about 40%. If they are lower, let's say they're 15, 20%, that means there's probably some deferred maintenance and there's some issues with the property, issues with the units. Maybe some units are down, they're not able to be rented, they need to be renovated, all that kind of stuff. If it's higher than around 40%, let's say it's 60%, that means they're spending way too much money compared to what they're bringing in, and there's likely some room to cut costs. Could also mean things like over renovation, improper capital allocation, all that stuff. And again, that just gives that's 40% number is just a general number. But if I see this as again like 25% or say 60%, then that's a major issue that I need to figure out if I'm comfortable with. That gets us to subtracting total operating expenses from up here, the gross rental income. That gets us to monthly NOI. Again, think of this like operating income for a stock or EBIT. This is monthly $13,863 and yearly $166,356. Is that good? I'll show you here in a bit when it comes to the metrics. But let's continue going down this, then we'll go up. You can even, in this software, add it in mortgage payments as well. For this one, I was going to try to do I can't remember exactly what I was going to do because these numbers, part of this was owner financing, which is what the interest only one was. So what I was trying to do here is I was trying to do get a regular loan from a bank for the first loan, for the first mortgage, to get most of the down payment or most of the money for to purchase the unit. The other loan was for to cover the rest of it, and this would be interest only. At that amount, that would leave us with almost $5,000 a month in cash flow. Again, is that good? I'm all about the numbers, all about the metrics, as you guys know if you've seen my other videos. Is that good? This depends on every individual property. For this one, this gets you a cap rate of 7.5%. This is the cap rate is what you would get if you paid as your investment rate of return if you paid for the property in all cash right up front. Cash on cash return is levered by compared to your down payment. So the yearly cash flow at $56,000 compared to the down payment of, where's the down payment of, there we go, $660,000. So that's the rate of return for that. Is that good? I look for both of these, cap rate and cash on cash return. Frankly, I don't care much about cap rate, honestly, because I don't plan to pay for things in cash, 100% cash unless I can get a great deal on it. So I mostly care about cash on cash return, but I look for anything about 10% on this. So this is okay. It's not great. This is an important number, debt coverage ratio. Banks look at this when they go to finance a property. Typically, this has to be above 1.5 to even consider, or for the bank to even consider financing it. So this property barely meets that threshold. I look for anything typically above 2 on this metric. Gross rent multiplier, think of this as a relative valuation. I look for anything below about 5-6 years. So this is kind of right on that threshold. And occupancy break even here is the amount based on the current numbers that you put in, what the property has to be occupied at to just make break even money. And this is 77%. They are above that. They only have 5% vacancy. So the numbers look pretty good, especially on the pro forma. When I make my adjustments, and I'll go through these briefly because it's pretty much the same numbers, is the slightly increasing the rents over time. That's what that increase is for the gross rental income on a monthly and a yearly basis. Increasing the RUBS/CAM income, that will add some more money into there in terms of revenue. Maintenance and repair costs. Why is it so high? I asked the broker that question because frankly that doesn't make any sense. This was essentially one-time renovation fees. They updated many of their mobile home parks, or not mobile home parks, mobile home units, and they updated these, which is why this number is so huge in this 1 year. Why did I put this over here in the next year? Because he said, and I took a drive by the property with his permission, he said that there are some other things that need to kind of be updated still. And that, to my opinion, was the case. But this still should be lowered because, again, I viewed the property. So let's go 1,500. So again, why do I have any number in here? Because I have the capital reserve in here, right? So the capital reserve is supposed to cover the maintenance and repair costs, right? Yes, it is. Again, this is for more of a margin of safety. So I do the same thing that I do when I am value investing into stock. I do the same thing and want as much margin of safety, as much conservatism in the numbers I look at as possible, just in case, or just for when things come up, that I'm not screwed and I'm still making some kind of return. This is a big difference too. Fire and liability insurance at $1,000 per year versus $16,500. So again, I saw this in the financials. I was like, that doesn't make sense. For a $2.4 million property, $1,000 in fire and liability insurance doesn't make sense. They were not paying for the proper amount of fire and liability insurance. So that's how I upped this amount. Again, this is a high amount, but I want to make sure that it's still covered. With the pro forma numbers, even making those adjustments, we've got total operating expenses down to 36.85%, which is, again, under 40, slightly under 40. So that all increases the gross income, slightly decreases the total operating expenses after making that adjustment, which increases the cash flow. So what does that do for our returns? Returns up here are 9.5% for the cap rate, 15%, just under 15% for the cash on cash return. Again, I'll look for anything above 10% there, and the higher the better. So that's fantastic. Debt coverage ratio goes up to almost 2%. Gross rent multiplier goes down. Occupancy break even point goes down. So I did this analysis. Property looked pretty good, right? Looks pretty good. Looks like it could earn you a high rate of return. with margin of safety built in. Looks good, right? Okay, I'm going to bring back my face here. Okay, so I saw this, and I'm a numbers guy, especially as you've seen in my stock analysis videos. I'm a numbers guy when it comes to first. If the numbers don't kind of mesh with what I'm looking for, I discard it and move on. Numbers here look pretty good. So I scheduled a time to meet at the property, or to drive the property. Me and my wife drove the property. It's about 45 minutes from where I live. Drove the property, and I've driven several mobile home community properties before, and I was expecting kind of not good, to put it nicely, because I've driven through some where I was like, I was even uncomfortable to be in them. This one was really nice. Actually, there was no major issues that I saw. There was some very minor upgrades to things like landscaping, maybe like repainting or pressure washing some of the outside of the units. That was it. It was very minor. It actually reminded me of a place that my grandparents maybe would have lived, because most of the community that I noticed when I was on my drive-through was older. So property looked good. Numbers look good. Talked with the broker. Put it in a letter of intent, LOI. This is the first stage to locking up a property and putting it, quote unquote, under contract when you want to buy it. Letter of intent is not binding, meaning it can be used as a negotiating tool. It's essentially for most people to kind of make sure you're on the same page, make sure you're not way out of the ballpark, in terms of price, in terms of terms, so you can kind of keep going on the negotiations. The time period to go from LOI to signed purchase agreement, which is the agreement to buy these properties and to put it fully under contract, is typically 5 days. So you have 5-day negotiating period, and that can vary. It can be 30 days, it can be 60 days, whatever. But that's the process to go from looking at the property and evaluating it. Then you do letter of intent typically. Then if things progress from there, sign purchase and sales contract. We got stuck at the letter of intent stage. Why? Again, the numbers look great, right? Numbers look fantastic, actually. The more due diligence I did on the property, another part of the LOI is to get more due diligence information. We never had a signed LOI, but to get to that process, I asked for more information. And with that further information, I kept digging and trying to make the deal work. What I found out is that I didn't think, with what I saw on these numbers, that even with these numbers, no one would know about mobile home communities. I don't think the property is worth that amount. I put a fair value kind of between $1.7 and $2 million on the property at the very high end. Realistically, probably 1.5 of the property. They're trying to sell it for 2.4. So I was trying to negotiate down the price to get what I deemed a fair price, and based on the actual numbers, not on my projections. So I don't do it based on my pro forma numbers. That's for my investors. What I show them, this is what could happen. For example, that's one thing. I show them everything, but that's one thing I show them, that's mainly for them and my potential upside. Me and my investors' potential upside is what the pro forma is for. I do my valuations based on the actual numbers, what they're doing now. And I found out, doing more due diligence, that I didn't think the property was worth that amount. And in real estate, so this is a major difference from stocks and real estate. If you're getting a loan on real estate, it has to be, to get the loan, you have to get an appraisal. The appraisal has to come back for either at the amount you're offering for or higher than that amount, or you have to come with more what's called cash to close. So for example, I thought this was probably worth about $1.7, $1.8 million realistically. They're selling for 2.4. So if it appraised for $1.8 million and the offer price was $2.4 million, I'd have to come with the extra $600,000 to buy it out of my pocket, out of my investor's pocket. I'm not going to do that. I'm going to either finance it or something like that if I can. So that was a big sticking point in the negotiations. What also is, so I frankly, I told the broker, I was like, unless he's willing to work out some kind of, the seller's willing to work out some kind of deal, there's no way this property is going to, it's not, I don't think it's going to appraise for that amount, is what I frankly told the broker. He said, okay, put me in contact with one of his contacts who funds a lot of these properties. And another thing that was an issue along with the appraisal was the seller, they were running it as an individual, like as themselves. They weren't running it as a company. When you do that, and in most cases you shouldn't do that, but when you do that, that brings more liability on your end because you're not protected from the legal structure. What does that mean? An LLC, if you own something in an LLC, say this mobile home park, you can't legally, depending on the structure, you can't legally get your personal assets taken unless you have a personal guarantee through a bank or something. It protects you from that. It protects your privacy and personal liability. If you run as an individual, you open yourself up to that. Because of that, the owner, because the owner didn't have an LLC, they were opening themselves up to liability, and they didn't want their public information out there. And I said, which meant they didn't want to give things like bank statements and a ton of personal information. I said, I don't care about that. I'm in finance and investment, so as long as I can tell the money is coming in and where it's coming in from and where it's going out and what it's going out to, I'm good. But because of the appraisal or the valuation issue, and because of this issue and the kind of information that was light, I don't think a bank's going to finance this. So this gets us to talking to that broker's connection. He said, actually, to my surprise, that they would finance the property with the limited information that the seller is willing to give. I was very surprised. I was like, okay, that's awesome. He did say, however, it wouldn't meet the appraisal. He said by their estimates, the property was worth at kind of its top level at about 1.7 million. I said that's honestly, I was about 1.5 to 2 million, probably in the mid range, about 1.7, 1.8 million. So that fits with my valuation. He said for that reason, we wouldn't finance it because most people don't want to bring an extra $600,000 to close. And I said, yeah, I'm not doing that. So what ended up happening is I took that information back to the broker, tried to get creative with things like master lease options and creative financing, seller financing. I tried, 3 to 10 different techniques on how to get the property. Couldn't make it work. The seller wasn't willing to budge on really anything, and I told the broker, I was like, the appraisal's saying this, I'm saying this. I'm not gonna go after this property because that would put too much risk on me, and I don't think it's valued properly and all that. And he said, okay, and we agreed to disagree peacefully, and that was it on this property. So as of this stage, I know, or again, as of about last week, the property was still for sale, and I first evaluated this in, August, probably June. So that's 2 months ago. Again, I was ready to go. I have investors ready to go to buy the property. But they, as far as I know, still aren't budging on the price. I still keep reaching out to the broker. Maybe something will change at some point, but as of right now, it hasn't. However, this is what will happen to the returns at its current rate if I can get it for, say, 1.7. So 1.7. Got to do the number, the mortgage down here, and I'm going to clean this up down here. I'm assuming there will be no seller financing at that rate. Just go pure bank loan. That would be, let's do 5 again for margin of safety. Years, 25 years. Okay, that's what that increases my potential, me and my investors' potential returns to. So this massively lowers the risk. Oop, I'm not sharing my screen, am I? Just realized that. Apologize for that. So, offer price, 1.7 million. I adjusted down below, and again, I adjusted down below the mortgage rate. That increases the cash flow. That increases the cash flow on both the actuals and the pro formas. Increases the doesn't increase the net operating income, but increases the cap rate, increases the cash on cash return enormously. Cap rate goes to almost just under 10%. Cash on cash return, and the actual numbers goes to 16.3%. On the pro forma numbers with some improvements, that goes to a cash on cash return about 25% per year. So what this does, if I can get it for 1.7, is it drastically lowers the risk. There we go. Drastically lowers the risk for me and my investors. Increases the rate of return for me and my investors. Lowers the risk, increases your returns. If you buy something that's overvalued, increases your risk, lowers your expected annual returns. If I can get this property, and again, I'm still reaching out to